What does the Fed's latest decision mean for global fixed income? Hi, I'm Daniel Shaykevich. Today I'll break down how the market is responding to the Fed's rate cut, what the recent economic data is signaling, and where we see opportunity, including in emerging markets. The Fed decision came very much as expected. The Fed is confirming the rate path the market was already pricing in. So economically speaking, we've seen the impact of this decision before it took place. However, there is a significant psychological component. Because we're now officially in a cutting cycle, and because bond yields for many bond funds and investments are comfortably above the Fed funds rate and above money market yields, we expect lots of investors who have been sitting in cash to continue to move money into longer dated bond funds. So the flows into bond funds should continue and may even accelerate. There are plenty of reasons to remain mindful of inflation. First of all, some of the long-term disinflationary forces from globalization are simply no longer present. Second, the constraints on the labor supply should keep unemployment in check and support wages. And third, we're actually optimistic that the economy can recover later this year and into 2026, and a stronger economy makes it easier for companies to pass costs on to the consumer. But in the end, nobody wants persistently high inflation. We all know the administration has argued for lower interest rates, thinking that that would benefit the economy. But they don't want to see rising inflation either. So ultimately, if inflation picks up, the policy mix is going to adjust to keep it in check. Over the past year, we were getting some very robust job numbers from non-farm payrolls data. Some of those numbers were almost incredible at the time, given what we knew about the reduced immigration from 2024 onwards, resulting in lower labor force growth. So these revisions should not come as a surprise. Ultimately, we're looking at the data, trying to gauge the direction the economy is going. And by revising the past year lower, it actually makes the trajectory today look more stable. Personally, I would not be surprised if growth actually picks up later this year and into 2026, given less trade uncertainty and supportive fiscal policy. We certainly don't want to be blindsided if the growth trajectory picks up and some of the rate cuts the market expects in 2026 prove unnecessary. Over time, the high level of deficit spending globally can certainly show up in higher yields on longer-term bonds. But in the short term, the premium on longer-term bonds is driven mainly by supply and demand. And with the Fed cutting rates, investors under-allocated to bonds, and yields still historically high, longer-term bonds should remain well supported. Emerging market debt is thriving this year, again proving its value to investors. Emerging market countries are generally in good fiscal shape, often better than their developed market counterparts. The bonds they sell tend to be longer duration, so investors can see significant price gains when yields drop or spreads tighten. However, investors do have to be careful. This year's performance leaves less of a valuation cushion, meaning you want to do your homework and focus on pockets of value. This is a key strategy in an actively managed emerging market bond funds. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.